Good morning. Happy Friday, everybody. Welcome back into Mining Stock Daily, this week's long form episode. It has been a very eventful and busy week here on the podcast. Hope you can go back and find all of this week's market updates and corporate updates of Mining Stock Daily. You can always find that on your podcast network or go visit us at clearcommodity.net for a rundown of not only Mining Stock Daily, but all the rest of the other content we published this week. Got a very special guest, first-time visitor, Mr. Mike Green, Chief Strategist over at Simplify Asset Management, who has been very critical on the role of passive investing in this market. So we kind of narrowed down that analysis into the gold and mining sectors here with Mike, kind of branching out a little bit. And then we also talked some big, broad type stories as well, including the role of the U.S. government taking equity positions in resource development within the U.S., and then some other geopolitical type discussions here within that grand scheme of mining and metals. So special thanks to Mike for joining me. First time he's ever been on this podcast. Special thank you to Visa Silver, Integra Resources, Equinox Gold, and Revival Gold for the continued support of Mining Stock Daily. And as always, please leave a like, a reply, comment constructively, please, and share with like-minded people. All right, everybody. First time here on MSD, Mr. Mike Green. All right, I'm really excited to jump into this one. Mike Green, welcome to Mining Stock Dailies, where you will share your wealth of information and knowledge on all things metals and miners. Thanks for so much for doing this.
Very happy to do so in exchange for the coin of the realm. I want to be paid in gold for my thoughts, though.
We could probably, it is a bartering means of transaction here, so we can definitely make that happen. I'm hoping, listen, I want to start things off, and I want to share something, and I hope this kind of, I can express a little bit of humility to start things off. This is the second time. I've been doing this podcast for about 7 or 8 years. This is the second time where I literally had a hard time sleeping the night before an interview. The first time was the night before I first interviewed Grant Williams, because, just this icon of a man and knowledge of information. And he really allowed me to see the world differently through markets. And so I was up that night, just a freaking nervous wreck. And all things was fine. We did the interview, and he's been on multiple times. The second time was literally last night, Mike. I want to hammer this thing out. You and I have had a chance to meet in person, and just seeing you work and not only listening to you. I've heard a number of interviews with you on different programs before. But seeing you in person when we had dinner with our mutual friend Dimitri Kafinas earlier this year in Arizona, to actually watch you kind of think and express your analysis and your views was a totally different ballgame. And so I hope I can provide a great platform for you to do just that. But I just wanted to share, I'm a nervous wreck over here.
I don't want to disappoint your audience after that build-up, but I'm fairly comfortable that your lack of sleep and challenges last night probably had more to do with the chili and the burgers than it had to do with the impending guest. But I could be wrong, so let's see where we go.
It might have been more of the beers. I did see a good concert last night as well.
All right, there you go.
I promise.
See, that makes much more sense.
You've been really outspoken here on the dangers of passive investing, and there's a lot of content out there, and we don't need to go rehash some of this analysis. I think you've done it plenty of times, but I do kind of want to focus a little bit more on what it means for this specific audience and our listeners who focus on resources, metals, and the miners. You've described the current equity structure as broken. Passive investment flows into ETFs can be a real detriment here when things potentially do break. But how does that passive mandate's bias towards large cap concentration specifically distort valuations of liquidity in smaller caps, specifically with resources or even precious metals ETFs?
Yeah, so the biggest issue for the precious metals and the miners, and I think you've actually seen this with the lack of participation until very recently in this gold rally, there's just no sponsorship for them, right? So if everybody is putting money into their 401k and doing so through something like a target date fund, your typical target date fund will have exposure to the Vanguard or the BlackRock Total Market Index, right? They're actually the CRSP indices, in which they buy every stock in proportion to its market capitalization. Should I buy gold mining stocks? Oh, I've already got them. All right. Well, what's the proportion that you have them? Well, 0.003% of my portfolio is in gold mining stocks, but I've got them. And the market has made the decision in its infinite wisdom that that's the appropriate weight for those stocks, right? So the mere decision to actually move to that diversified benchmark, among other things, reduce the incentive for people to make secular or sectoral bets. And I'm making both of those statements independently, because the general belief was, well, you're fully covered, right? You've got exposure through the market. You've got large caps, you've got small caps, you've got international stocks and the international component. What weighting should I have on these? Well, we'll by and large let the market decide that within equities, right? So if you just mechanically imagine a scenario, right? This is almost a variant of Bill Sharp's The Arithmetic of Active Management. If everybody in the entire world decided that they wanted to allocate 10% of their portfolio to gold miners, right? What would the market capitalization of gold miners be relative to the rest of all securities? 10%, right? It has to be by definition. And so when people are making active decisions to segment a portion of their portfolio, I'm going to put 5% in gold miners or 15% in gold miners, they're deviating from the benchmark weights. If everybody defaults into the benchmark, it makes it harder and harder for the individual securities to actually leave those benchmark weights, because the incremental flows are simply pushing them back in that direction. Does that make sense?
Yeah, it does make sense. And I want to add on to that, just the amount of trading of derivatives with these ETFs. How much is that really playing a role here with some of these big ETFs, specifically resource stocks?
Yeah, I mean, the most important thing to understand is that we have replaced a traditional allocation process in which we think about higher prices with no change in fundamentals. That's viewed negatively, right? If the price of gold miners went up 500%, and the price of gold were unchanged, you would likely say, okay, I think gold miners are probably overvalued at this point. Their forward returns are going to be lower. Therefore, I'm more willing to sell gold miners than I am to buy gold miners, right? An index strategy does the exact opposite. If they go up a lot in price, the next dollar that comes in is going to allocate more to them. And so it becomes a momentum reinforcement vehicle. Now, momentum has its own characteristics. Among them is the component of persistence. If I keep adding more money to stocks that go up, those stocks are more likely to go up, which means I'm going to keep adding more money to them, which means they are more likely to go up. And that's how you get these types of secular runs. When you see something play through like you're seeing right now, where suddenly gold has actually captured people's attention and people are actively saying, hey, wait a second, I want to allocate some money to gold miners, it can take on characteristics because you've actually now introduced a demand function on the discretionary manager. I can't tell if you're frozen or if you can hear me. So you've introduced a demand factor on that discretionary trader that then will be amplified by the passive player, right? If I get the price of Barrick mining to go higher, it's going to receive a higher allocation relative to what it was receiving before. That gives it an incremental impulse. I actually have just recently started to share some of this stuff. Let me actually pull up an example of this so you can actually see this. And this is, I want to emphasize, like, there's a degree of false precision in the numbers that I'm going to show you here, but that's simply just the math. And I'm expanding the number of decimal points so it's easier to actually see. Give me 1 second here I closed my Bloomberg because, there we go. Okay, good. Okay, so I'm going to share my screen if I can find where to share it. There we go. Okay. So this is looking at a super simple example. We've got the S&P 500 I've picked the biggest stock in the S&P, or roughly the biggest stock. I actually understand that NVIDIA and Microsoft are larger. There's some interesting features around Apple that makes it easier to demonstrate this. But this is simply the largest stock, or roughly the largest stock, and the smallest stock in the S&P 500 right now. Okay? Assume like it's a normal day, Vanguard receives roughly $1 billion in inflows. It's actually up to about $1.5 billion now. That means that Apple will receive a buy order for $70 million, and CarMax is going to receive a buy order for $100,000. The daily trading volume of Apple is about 12.4 billion. The daily trading volume for Carvana is about 206 million. Right? So if I just very quickly do the ratio of these two, right, you can see that the Apple order is taking roughly 12 times the liquidity as the CarMax order. And as a result, its price impact is magnified. It causes the price to go up more every single day. It's positive on CarMax. You would expect that. It's a buy order, right? But it's a fraction of the price impact that you have on Apple. And assuming some form of competitive response, meaning people see the price change, they try to arbitrage it away, this annualizes to adding about 20+% a year to Apple's total return, and only about 8% to Carvana, right? And so this helps to explain why we're seeing the bifurcation in the market that we're seeing. Crazily enough, this is virtually all of the return that Apple has experienced on an annual basis over the last 5 years. And if I do Apple on a fundamental basis, I would suggest that reversing all of that impact would bring it much closer to my estimate of fair value. We don't really want to go there in terms of how far off of fair value I think we actually are on Apple, but suffice it to say it's record levels. We can take this a step further and look at the median stock in the S&P and the market cap weighted average. This is the divergence between the equal weighted S&P and the market cap weighted S&P that many people have made huge focus on, right? Now imagine that there's only one gold mining stock in the entire S&P 500, right? How much interest is there in gold mining stocks? And this is where it gets really perverse, because the price impact is larger on the largest stock. The next day, I actually increase my buy order in Apple and shrink my buy order in CarMax because of the relative performance of the two. Day 3, this continues, right? And so you actually see this bifurcation that's occurring that's a function of two things. One is the growth in the share of passive, and the second is the concentration of the index. The more concentrated the index gets, basically the larger and larger the impact on the largest stocks, the more they effectively come to define the behavior of the index itself. This is all using very accepted formulas, very accepted analysis. It's just nobody had really thought to break this down into the repeated game of, well, what happens if the flows come in every single day, which is really what's happening with passive investing. Right now, you asked the question about how important are things like derivatives and how important is passive. This is really what's changed so remarkably. Most people don't fully appreciate how large passive has gotten. In fact, one of my favorite papers, one of my favorite academics, Marco Salmon, has a paper that is literally titled, "The Passive Share is Double What You Think." And so over the past 30 years, we have just seen explosive growth of passive investing. Today, my estimate is we're north of 50% of total market cap that is now actually contained in passive vehicles. Marco's work, which was dated as of August 2022 and using data up until the end of 2021, came to the conclusion that about 38% of the market was passively invested in only 5 indices, and excluded the total market indices in that analysis, right? So, all this discussion about active ETFs and the proliferation of indexes, etc., it's largely meaningless. There's basically the S&P, the total market index, etc. Nowhere in there did I mention gold miners or a gold miner index or anything that would allow you and your investors to benefit, except when people eventually wake up, and they're going to wake up late, and they're going to come too aggressively to the party when they do. Right, because they will interpret those higher prices, just as we did with GameStop or ARK Innovation Fund or any of those, as conveying fundamental information, about the future. You currently hear it embodied in the debasement trade, right? It's all explainable by debasement. We're just printing dollars. The dollar's going to be worthless. Well, that's funny because the dollar's actually worth more versus the euro than it was 6 months ago, right? It's worth more versus the yen. It's worth more versus the Swiss franc. We're actually seeing the dollar generally appreciate on a trade-weighted basis across all trading partners. That isn't a debasement trade. Right? What is happening is in 2022, we told the rest of the world, hey, it's really not safe for you to hold your reserves in US treasuries. And by the way, we don't like China so much anymore. And so all the dollars that we send them through our trade deficit with China, they needed to figure out a different place to put it. And they put it in gold.
Yeah. So the move in gold, just the price action in gold alone, obviously had a positive impact with the gold mining equities. But that GDX historically is still, you can look at the chart compared to where it was last cycles and say, my God, why is it not 3 times higher, since the gold price is 3 times higher, and some of these miners were, a lot of the least, not the majors, not the Newmonts or the Barracks, they were not running as high as like some of their peers, mid-tiers, I guess you can say, which I would argue are the lowest cost producers and probably the best bang for your buck. We're kind of getting into the weeds here, but it's just kind of interesting. And if we look back,
very quickly, like I used to run small cap assets, no gold mining very, very well. Was a big gold bull during the time period from 2000 until give or take, really 2001. Until give or take 2011, 12. And then I started hearing conversations that are very, very similar to what we're hearing today, which is, the only thing I believe in is gold, right? Today, you're seeing similar stuff, but it just depends on where you are in the cycle, right? So the leverage that you're looking for in a gold miner, in which the price of gold goes higher, that increases their profit margins and increases the quantity of reserves that are economic, isn't your low cost producer. It's your high cost producer, right? And so where you tend to see mining cycles play out is people start chasing the truly speculative stuff. They're not looking for Mark Bristow at, Barrick, who's, built a long, steady career in the industry, building relatively low cost, high quality products that ultimately he sold to get himself elevated up to the point that he's at. Instead, you actually are going to go find some Canadian venture exchange entity that says, our average cost of gold is $2,500 an ounce, but if the price of gold goes to 10,000, we're going to make 1,000,000 times more money than we currently make today, whereas Barrick would probably make 3 to 4 times as much. So it just depends, right? It really depends on where you are in the cycle. And all of the indications we have is that this cycle started in China. It has been enhanced by the use of leverage and financial instruments in China. And Americans have been, Western investors more broadly than just Americans, have been slow to recognize this and chase after the increase in price in gold. But now they seem to be the big players.
Yeah. You've mentioned before that it's difficult to identify like true value opportunities in the general scheme of the market that we are faced with. But as the margins have continued to improve for the gold miners, is that a true value opportunity, or have you learned enough lessons working in gold miners before to realize, no, this is you basically are renting these shares for a time and enjoying the profits?
I mean, the quick answer is, I still think Mark Twain has a phenomenal definition of what a gold miner is, right? It's a liar standing next to a hole. Is that absolutely correct? I don't think that's entirely correct, but there is more evidence of it than anything else, right? So I just always, caution people, particularly individuals, know what you're doing, get deeply involved in the research, understand the companies. If the management team's lips are moving, that means they're lying. If their lips are not moving, that means they're dead, and makes them likely a better investment. But it's a devilishly tricky place, and you ultimately have to accept that you're going to be caught up in the forces that are much bigger than you, as I was describing, things like the passive flows. If you start seeing these prices appreciate and they start becoming larger shares of indices, you're seeing this in its extreme form right now, where the Russell 2000 value, the single largest stock in the Russell 2000 value, is Okla, which is a pre-revenue garbage company, right? Pure speculation. That Vancouver exchange gold miner, cubed sort of stuff. Those forces are going to far outweigh any type of security analysis that you can individually do. And as a result, just be prepared to have humble pie thrown in your face over and over and over again as you go through this process. But if you do dedicate yourself to securities analysis in a Ben Graham framework, you will ultimately end up owning things that you want to own. And so, like, if that's your objective, if you genuinely believe that gold miners are going to experience much higher profitability and are going to start returning cash to you, you might be less entranced by that if your actual thesis is cash is going to depreciate and cash is worthless. Why do you really care? But at least you know what you're doing.
I want to spend a little bit more time. Actually, it's maybe fortuitous that you and I are having this conversation today, because I think it was Monday. I saw my first twice levered ETF on MP Materials.
Yeah.
On a specific resource company. I mean, this stuff is just getting out of control, Mike. We obviously have more ETFs than we have equities, at least in the major big boards.
So to be very clear, that actually doesn't bother me, right? More ETFs than you have equities is a little bit like saying, hey, there's more words than there are letters in the English alphabet, right? That shouldn't surprise anyone, right? ETFs and portfolios are combinatorial factors. You should have more of them than you have the underlying. There are more molecules than there are elements, all sorts of stuff, right? The question is, like, what are we actually doing when we're introducing a 2x levered mountain pass ETF? Like, what you're actually doing there is you're engaged in regulatory arbitrage. For me as an individual, I can rarely obtain leverage on something like Mountain Pass without using either options, which are dubious in their return profile, or by using margin borrowing in my account at a brokerage firm. That margin borrowing is typically going to be somewhere in the 8 to 13% range in terms of costs. And I'm going to be limited to 50% of the shares borrowed on margin. Under most circumstances, it can be even lower than that, depending on the volatility. A 2x levered Mountain Pass ETF takes advantage of two features. One is an institution who's running that ETF. My borrowing cost is about 4 to 4.5%. Right? It's actually a little under that right now. That means I can obtain more leverage more efficiently and at lower cost than you as an individual can. I can also offer it to you in a non-recourse framework. The worst that happens in that ETF investment is it goes to zero. You lose your investment, but it doesn't put at risk your other investments. You're not forced to meet a margin call, right? So those are all positive features, but then there's also just this broader question of, like, why? Why do you want leverage to a speculative mining stock that honestly has had multiple goes at trying to become a productive facility and has failed over and over and over again? Because the simple reality is that the economics of mining rare earths in a country like the United States that prioritizes pollution and environmental concerns, etc., is a really, really hard thing to pull off.
Mm-hmm, mm-hmm.
Right. So, like, why do you need 2x leverage?
Yeah, it's a great question. And, a couple months ago, we actually had the CEO of Granite Shares here on this podcast. And I was trying to, constructively pry into asking him why a company like Granite Shares would continue to add, more leverage ETFs. What was the necessity of continuing to add more of these funds into his portfolio? And he said, he's clear as day, is like, if there's demand, if the investment community is looking for it, we can offer it. So we're not much different than any other business who sees a problem of people needing something, and we can provide the solution for them. And so, I mean, I kind of get it, But I also was like wonder like, okay, well then who takes the blame if something that catastrophic as you and Mike Green are trying to warn people about? Who takes the blame? Gets the finger pointing.
Well, I mean, this is unfortunately part of why I continue to talk about these things. Not so much because I actually think we're going to change anything, right? We have entered the stupid period of our lives in which we're going to pursue every dumb idea to its logical or illogical conclusion as it may be. Whether that is crypto or gold, which some people might argue, right? And why does Granite shares offer 2x or 5x or 20x products? I would flip that, right? So Say's law is supply creates its own demand. There is no latent demand for 5 times levered ETFs from thoughtful individuals who are interested in actually executing a well thought out investment policy. There's a ton of demand for hard eights on a craps table, right? It's not a good bet, but we facilitate it because it transfers more money into the casino's pockets on average. And that's really the motivation for Granite shares, or candidly almost anyone, myself somewhat included in the industry. Like, I want to get paid, right? And if somebody wants 5x levered and I can create it and offer it, it's pretty judgmental of me to decide that you don't know what you're doing, right? Now, the math suggests you don't know what you're doing, but if you're going to pay me for it, fine. I ultimately do think that part of what is going on in our society, right? I used to manage money for Peter Thiel, and Peter's known for his following of Rene Girard. Girard's whole thing is what's called mimetic desire, right? We basically want what other people have, right? Your wife individually might be attractive to you, but at least that is influenced by how other people perceive her, right? If you were to see people looking at your wife being like, oh, she's gross, that would have a negative impact on you, even as it made you angry and wanted to defend her, etc. Like, it's just a terrible outcome. And I have no idea what your wife looks like. This is not focused on your wife. She's listening in. I apologize. She's gorgeous, right? But the simple reality is that we all basically want what other people have, and we see wealth. We see it displayed conspicuously, and we all imagine that the path to getting there is through various forms of highly volatile and leveraged instruments.
And the algorithm that feeds us our communication information is also feeding us that idea
100%.
of what
It's designed for that, right? And the other thing I would suggest, and you asked, like, who's going to take the blame? One of the reasons why we have this time period right now is that we've gone through a roughly 15-year time period from the global financial crisis, 16 years in total, COVID on down, in which there hasn't been a single real perp walk, right? We had the opportunity for, a genuine cleansing and scapegoat with Epstein, and he robbed us of it by, his choice of self-care. That's what people are looking for. They want to know who to blame. And in the absence of somebody being blamed and cast out and, excised as a scapegoat, we're just going to get crazier and crazier in our behavior until we get that type of resolution in which we all suddenly wake up and say, oh, thank goodness we've been cleansed of our sins. Now we can go forth and sin no more.
We can't politically do it, though. It's a kiss of death for anybody with any sort of political power.
I agree, and that tells you that we are not yet at the point that things are going to turn. I would push back a little bit. I'm actually starting to see growing awareness of this. I'm starting to see more people say there have to be consequences, and there are no sacred cows in terms of who gets to stand here and present themselves. Candidly, my wife worries all the time. She's like, well, how do you know you're not going to be the person who's blamed for it, having highlighted the mechanism? And I think there's a very realistic chance of that. But, what I'm angling for more than anything else at this point is the opportunity to be part of the group that rethinks how this should work going forward, right? Basically the Pecora Commission for the probably 30s.
Yeah. There was conversations of this during the first month of President Trump's second term here. Scott Bessent, Treasury Secretary, was out there communicating, we need to cleanse ourselves from the rise of government spending. And so there was hope, and I agree with you. Like there is communications, but like that's been a hard shift here as of recently, where there's no sign of government spending slowing down. Our
Oh,
friend
so
Barry
that's
Knapp
actually not
continues to
true.
tell us that.
Yeah, actually, there's
Oh,
very strong indications of fiscal consolidation. So the issuance of debt has fallen meaningfully. It's one of the reasons why we're seeing rates better supported. The tariffs are having a much larger impact than their critics were willing to acknowledge. And, you know, certainly our availability of data is influenced by the government shutdown, but the data is actually pretty robust that we have begun to consolidate the deficit and shrink the debt on a debt to GDP basis, as much as that's contrary to the narrative of the debasement trade. I actually put out a tweet on this about 4 months ago saying, one of the most virulent forms of Trump derangement syndrome is the inability to actually see fiscal consolidation when it's happening. Now, I want to be, again, perfectly transparent and clear. There are rumors that the surplus that's been generated from the tariffs will be returned in the form of, a dividend to households that's stimulus to drive Republican success in the midterms. That's perspective. I have absolutely no insight on it. If I did, I'd tell you, but I don't. And so, maybe we still blow this up. Who knows?
okay. Speaking of tariffs, and this is a big point, I wanted to actually have a conversation with you. The U.S. Supreme Court scheduled to hear oral arguments on the legality of using these tariffs under the Emergency Economic Powers Act, International Emergency Economic Powers Act, or IEEPA. Court's going to take up those arguments early part of next month, November 5th, so in a couple of weeks here. Watching that, how closely are you paying attention to this, and what could the implications be on this decision, which probably wouldn't happen until later in the winter? But what implications would this have on the current state of the markets as you see it, where we're at here in the U.S.?
So just very quickly to orient people to what the discussion is, the debate is whether the tariff policy and the execution of tariffs at the level that is being done by the executive branch is legally supportable as a framework. My expectation is that the Supreme Court, which is very focused on the idea of reining in judicial activism, is ultimately going to be supportive of the Trump administration. I don't know that, right? Again, it's speculation. And so ultimately, I think the tariffs are going to stand, and we're going to see a period of deglobalization or of reshoring, friendshoring, strategic sourcing, et cetera, that's going to continue to play through. Whether that ends up being very costly, whether that ends up being transformative in the way that Secretary Bessent has hinted at, we simply can't know, right? Again, it is perspective and its underlying observation. My opinion is that the Supreme Court will ultimately support the expansion of the executive branch in an attempt to dial back the activism that has dominated the Supreme Court really since the Warren Supreme Court, the Earl Warren Supreme Court in the 1950s and 1960s. This is a very big secular change and structural change, and what we don't know are what the implications of reining in one of the checks and balances that has probably gotten too large. I mean, if you think about the three components of the checks and balances between Congress, the executive branch, and the judicial branch, the executive branch and the judicial branch have expanded dramatically. The executive branch far more in the regulatory framework, the expansion of entities like the EPA or OSHA, et cetera, that have made it very difficult for many businesses, particularly mining companies, to expand their operations. The weak player is Congress, right? They've done nothing effective for decades at this stage. And, I often draw the analogy not to the end of the Roman Empire, which everybody points to as a collapse in inflation and debasement, but instead to the collapse of the Roman Republic, which was the loss of the democracy and the transition to an autocratic form of government. An autocratic form of government is simply adding efficiency to the public sector. You dispense with debates about what you're going to do, and you say, we're going to do what that guy said. Right? Why? Because he's king. Right? And if I don't do what he says, he has the flexibility to release the National Guard or the Praetorian Guard or whatever we want to call it in this cycle to imprison me and beat me to death. Beating me to death is more efficient than imprisoning me because it removes the potential for me to sway public opinion in the future. right? We'll eventually get there if we continue moving down this path. But that's a long way away. And the other thing to point out is that the Roman Republic collapsed in a period not of debasement, but actually of a deflationary bust and collapse of retirement systems, very much like my work on passive suggests is possible. That's what led to the collapse of the Roman Republic, was the breakdown of the system of the granting of public lands to soldiers after their service. That was the equivalent of a pension plan imploding, and it allowed Caesar to rise to power by solving it through a variant of a debt jubilee, a restructuring of debts. My hunch is we're going the same path this time. And if anything, the performance of gold is telling you people are trying to get outside the system, not so much flee inflation. I don't see the evidence of the inflation. They just want to get away from somebody owing them something.
Yeah. There's a book out about that, and I think you mentioned it to me earlier this year.
I talk about this book all the time. It's called The Storm Before the Storm. It's by Mike Duncan. I'm sorry, and it's phenomenal. Really, really good book. It's a period of history that I think most people are unfamiliar with. We all understand the idea of the fall of the Roman Empire. It sounds dramatic. We get invaded by barbarian hordes, etc. It's really hard to defeat the United States without fracture. And the failure of the Roman Republic was ultimately a story of civil war. We've had one civil war in the United States, which we resolved in the direction of maintaining the Union. There's no guarantee of that. And we already have, heading onto the ballot in California, secession measures. Texas is talking about it again. Oklahoma has flirted with it. Northern states have flirted with it, etc. Right? Like, we're doing everything we can to recreate the gameplay that led to the breakup or the end of the Roman Republic, not the Roman Empire.
If we do transition from a republic to this potential American empire, if we replicate what happened with Rome in the same period, I know this is kind of really digging in the weeds here. Does that strengthen the U.S. dollar as a global currency? If we are,
I would expect it would. Yeah, I mean, the simple reality. Look, it introduces a degree of capriciousness, and it's always possible to have a bad leader. This is where I disagree with, the Curtis Yarvins of the world, who will argue that monarchy is a more stable form of government. No, it's not. Like, if you get a good dictator, if you get a munificent and beneficial dictator who's more interested in the wealth and success of the populace, Lee Kuan Yew comes to mind in Singapore, for example, a largely non-democratic system in which oppositional parties were not really allowed to run, not really allowed the potential for success. Things can go very well if you've got a good leader, right? Things can also go terribly poorly if you've got a Peronist, for example.
Yeah. We are definitely seeing a emergence of capital coming back into America's resource sector, and even the U.S. government or the Department of War taking equity positions in specific companies here. I've asked a lot of people the same question about thoughts on the appropriateness of the U.S. government doing such deals, but maybe on the big grand scheme of things, Mike, it seems more like started as reshoring supply chains, but now we're getting to a point where it feels like the narrative is remilitarizing supply chains. And as you're watching this, how are you kind of watching flows of capital into America's resource sector, and how closely should we be watching this?
So I have to be somewhat careful in what I say here, because I actually have been fortunate enough to get pulled into some of these discussions. Look, I don't think there's anything wrong with the government actually deciding that it's going to take a thoughtful role in either taking ownership positions in strategic businesses or in funding development if it is not happening in the manner that it should, right? Carl Polanyi, who was a 20th century economist, a contemporary of Keynes, a little bit younger, and also friends with Hayek, and all those guys were actually quite civil with each other. Let's be very, very clear. One of his key points is there is no such thing as a free market. It's always designed by the participants and the policymakers. If you go to a Moroccan souk, it has rules. When does it open? When does it close? Are there licensed carpet sellers or just random people off the street? The answer is there's licensed carpet sellers. You have to purchase a stall and you have to gain access to the tools, etc. All of those represent rules, right? We have chosen to abrogate the rule-making process in the United States in favor of saying whatever goes in the market. Right? This is Carl Polanyi's observation that a society that outsources its industrial policy to the market is a society that is doomed for failure. Right? We have failed to make the hard choices, the national security choices, the choices that allow us to maximize our safety and independence as U.S. citizens, which is the entire point of a republic. You elect leaders as your proxy to make choices to maximize outcomes for for the individuals that they represent. By and large, that's what's been missing. We've had a largely diplomatic class that has emerged that has basically said some variant of, well, what we're really interested in is attending polite cocktail parties in Europe so we can celebrate all the wonderful things we're doing for the environment. We don't really want to do anything for those great unwashed. And anytime you hear somebody who says something along the lines of the carrying capacity of the earth is about 1.5 billion people, you honestly should look them direct in the eye and say, so what you're actually endorsing is the ultimate solution of Hitler, just at a scale of 6 billion instead of 6 million, right? The reality is that the carrying capacity of the earth is always going to be a function of our ability to harness energy. Mining is one of the ways in which we harness energy. Recycling is another way in which we harness energy. Environmental remediation is another way in which we recycle energy. All of those have allowed the Earth's carrying capacity for human population to expand dramatically. And candidly, our elected representatives have lost sight of our interests for give or take the last 20 to 30 years.
I would certainly agree with that. The last idea, and this is one that actually our friend Brent Johnson kind of posed to me on Twitter, but we're discussing a little bit more of the interest of U.S. this administration with South American companies and countries, excuse me. So we've seen the headlines out of Venezuela. There's a little bit of poking and prodding on social media towards Colombia. The relationship with Brazil continues to be, I guess you could say, evolving. But it certainly feels like the fragmentation from east to west continues to widen the divide a little bit, and that the United States is potentially, in the long run, is becoming a little bit more wanting to become shoulder to shoulder with South American countries, potentially because of incredible resource development, untapped resource development. Do you see it that way, or is this something that too early to tell?
I think it falls a little bit into the too early to tell, but I also would just take a very different perspective on it. This is just the Monroe Doctrine of the Western Hemisphere being reasserted. We're not actually interested in blowing up Venezuelan fentanyl dealers that are trying to make their way across, right? What we actually care about is control of the Caribbean and the Panama Canal. And that is coming, right? We will take back the Panama Canal in everything but name at minimum, and possibly in name. We've just made incredibly weak choices as a global hegemon. And some of those are going to cause conflict in a variety of ways, but it's no different than what you would expect if Rome had stopped policing the roads in Gaul. There'd be an uprising of Gaulish terrorists, and then Roman centurions would have to storm into Gaul and reclaim, the control of the system, i.e. exactly what Caesar did, right? This is underway. The United States has, I talked about this back in 2016. I actually did an interview with Luke Groman for Real Vision, in which I highlighted my overall philosophy on this, which is that the U.S. has indeed been an empire, but it has been a somewhat uniquely munificent empire, and that it has broadly said, let's lift everybody up. We're just going to lift ourselves up a little bit more, right? The vast majority of history has involved one form of conqueror subjugating another group of entities and often deciding that they want to make their lives so miserable and so impoverished that they have no prospect of revolting, right? The US took a very different path. And I think by and large, that's been interpreted as weakness by many that are even our allies, right? The Schadenfreude in Europe at any sign of disintermediation of the US's role as global hegemon has been a variant of glee, I think is the easiest way to put it, right? And it's like, oh, the Americans are going to get their up and coming, right? The simple reality is that Europe has been massively devalued in global strategic importance. It's not even a continent. It never has been, really. We just treated it that way because we didn't want to insult them. But the simple reality is it's an adjunct to the Asian continent, the supercontinent of Europe and Asia together. And if the United States didn't protect it, it would be a Soviet, sphere, or it would be a Chinese sphere influence. If they want us to protect them, they basically have to do what we tell them to do. Latin America, South America, multiply that by 5.
Well, we'll see this, kind of watch this play out, and it's just going to be fascinating to watch all the developments come down the pipeline.
We are moving. There's a great book out there called by R.R. Reno. It was actually recommended to me by the U.S. military. It's called The Return of the Strong Gods. R.R. Reno is a theologian. I'm sorry. He has 2 lines in there that I think are actually really important. The first one is one that I would just encourage people to really ponder and think about, which is the most valuable asset that most Americans have is their American citizenship. That's actually our most valuable asset when you think about it. Now, it comes with responsibilities and it comes with obligations that often people don't like. And it comes with some issues on a geopolitical basis. But what we are seeing from the Trump administration, whether it's raising fees on H-1B or introducing potentially a golden visa or other components, is we're starting to move towards identifying the market value of that. Right? We're starting to think about how do we actually value that. And once you start measuring it, you can actually start trying to maximize it. And so I would argue that that's one of the directions that we're going to actually head, is we're going to get a better idea of the transparency and value associated with U.S. citizenship and belonging to that hegemon that by and large can do what it wants in the world. That doesn't mean we should, right? I just want to be very clear, like we can in most situations. That would be a huge asset. It would be a really important thing. It's the equivalent of measuring defects when you're manufacturing cars, et cetera. If we figure out what the value of a U.S. citizenship is that going up or down? Is it making our lives more worthwhile or not? We can actually start discussing policies to improve that. And so I'm very encouraged that at least we're starting to think about that, as compared to what we've done for the last decade, which is basically argue some variant of like, well, Americans are inherently evil, and we inhabit a space in which we're taking advantage of an existing patriarchy and colonialism and everything else to exploit the rest of the world, even as we were behaving, as I pointed out, among the most munificent hegemons in history. So, that is underway and that change is in place. Now, as we raise the value of that citizenship, just like we experienced in Rome, we're going to see greater and greater pressure from our allies to allow them to participate in that benefit as well. This is what the social war was all about on the Italian peninsula in that time period. And my guess is we'll see some variant of that. Right. The other thing that I am really, really hopeful for is that we're starting very, very beginning to rethink how we allocate resources in our society across generations. Everything to this point has been done to preserve the wealth of the oldest generation. And the simplest explanation for that is that in this generation, we moved away from annuity-based saving systems, things like Social Security or defined benefit pension plans that guarantee a level of income into retirement, which allows you to budget efficiently, and replace that with a volatile asset level. Right, that volatile asset level, we're expected to spend down the proceeds of that and roughly exit with spending that is similar. If your asset is volatile, you're going to underspend. That's really what's happening in our society right now, is that we built a retirement system that encourages people to save more and spend less. That spending less is Keynes's paradox of thrift. In the private sector, it means that the younger generations don't have the incomes that they should have while the older generation basically demands more and more and more transfers from the government, which has to make up for the lack of their spending. That's really what we're actually seeing, right? And the first glimpses that it's beginning to change are here, and it'll be helped candidly by the fact that the baby boomers will eventually move on, and maybe we'll have serious discussions about alternate approaches.
Mike, thanks so much for your time. Whenever I listen to you speak or get to have the opportunity to speak with you, I come away with another book on my reading list and a lot more things to think about that I will probably be twirling around in my head here for the next couple hours. Awesome. You do have a Substack out. It's free of charge, titled "Yes, I Give a Fig." It's a great read, and I appreciate your time, and just would point everybody out there. I'll try to put a link in the show notes.
My pleasure. I just want to actually clarify. It is actually not free, right? So, but there is the ability to be a free member. I'm actually happy to extend a discount to provide 1 month free if people want to try it out. No charge moving on, no skin off my nose if you decide that you hate my writing, etc. But I'm happy to send you a coupon, Trevor, that allows people to get a month free from the time that this episode airs.
I'm sure people will take you up on that. All right. Thanks, Mike. Really good to see you, my friend. Thanks.
It was great seeing you, Trevor. Take care.